Imagine the global economy as a complex high-stakes poker game, where one massive player just pulled a miraculous wildcard out of thin air, while another aggressive player is actively threatening to set the entire table on fire. Hello, this is Warm Insight. Today, we're going to talk about the massive China industrial rebound, the escalating energy crisis in the Strait of Hormuz, and how new artificial intelligence trading agents are completely rewriting the fundamental rules of the stock market. Leaving a like and subscribing is a huge help to us right now. The world is holding its collective breath, as the Strait of Hormuz remains an absolute powder keg of geopolitical risk and systemic economic danger. To understand the true gravity of this situation, you must realize that the Strait of Hormuz is not just a body of water in the Middle East. It is the single most important energy choke point on the face of the planet. Over 20% of the daily oil supply of the world, and a massive portion of global liquefied natural gas flow through this narrow channel every single day. When this vital maritime corridor is threatened or blocked by regional conflict, the consequences ripple out into every single aspect of your daily life and personal finances. This is not a new phenomenon for the global economy. If we look back through history, we can see exactly how devastating choke point disruptions can be to the financial stability of the world. Consider the 1973 oil crisis. During the Yom Kippur War, the Organization of Arab Petroleum Exporting Countries proclaimed a total oil embargo that completely shocked the Western world to its core. The psychological and economic devastation was absolute and unprecedented. The price of oil quadrupled almost overnight, and the economic shockwaves destroyed businesses across the globe. Everyday citizens were forced to wait in lines, stretching for miles just to fill their gas tanks to get to work. The resulting supply shock triggered a brutal decade of stagflation. Stagflation is a highly toxic economic combination of high inflation and stagnant economic growth that actively destroys the purchasing power of the middle class. Central banks are terrified of stagflation because raising interest rates to fight the inflation only makes the economic stagnation much worse. Today, the escalating tensions in the Middle East threaten to unleash that exact same economic nightmare, but on a much faster and significantly more destructive scale, due to the hyper-connected nature of modern supply chains. During the tanker war of the 1980s, both sides of the Iran and Iraq conflict relentlessly attacked merchant shipping in the Persian Gulf. That conflict resulted in the damage or destruction of over 500 commercial ships and caused massive spikes in maritime insurance premiums. The exact same psychological dynamic is playing out right now in 2026, but with highly advanced drone technology and anti-ship ballistic missiles. Shipping conglomerates are completely terrified of having their multi-million-dollar vessels seized or destroyed in the strait. This fear is forcing them to reroute massive container ships around the Cape of Good Hope at the southern tip of Africa. This immense global detour adds weeks of transit time and burns millions of dollars in extra bunker fuel for every single commercial voyage. These exorbitant shipping costs are never simply absorbed by the massive corporations. They are passed directly down to the consumer, meaning you pay significantly more for everything from basic groceries and clothing to advanced electronics and vehicles. This constant upward pressure on prices acts as a massive global tax, reigniting the terrifying flames of inflation. Just when the central banks of the world thought they finally had it under control, when a massive container ship is delayed by 3 weeks, it does not just mean a late retail delivery for a consumer. It means a heavy manufacturing factory in Germany has to completely halt production because they are missing a crucial microchip. It means a farmer in South America cannot get the chemical fertilizer they desperately need for the next planting season. It means retail giants in the United States have to drastically raise prices on everyday consumer goods to offset the massive increases in maritime insurance and transportation costs. This is the exact anatomy of supply chain-driven inflation, and it is a vicious self-sustaining cycle that central banks are nearly powerless to stop using traditional monetary policy tools. The smart money investors, the multi-billion-dollar hedge funds and massive sovereign wealth funds are intensely monitoring this geopolitical friction. They know that as long as the Strait of Hormuz remains a flashpoint, energy prices will remain highly volatile, acting like a dark, heavy cloud over the entire global macroeconomic landscape. They are pricing in the reality that geopolitical risk is no longer a tail event, but a persistent permanent feature of the new global economy. But while the retail investment herd is completely paralyzed by fear and obsessively watching the doom and gloom news cycle regarding the Middle East, the institutional titans of capital are quietly deploying their massive wealth into one of the most surprising economic developments of the decade. Deep in the heart of Asia, the Chinese industrial engine has just roared back to life, with a sudden ferocity that has caught almost every mainstream financial analyst completely off guard. According to the latest official economic data, Chinese industrial profits surged by a massive 24.7% in the month of April alone. This represents the absolute fastest pace of industrial growth in over 2 years, and it completely shatters the prevailing media narrative that the Chinese economy was entering a permanent terminal decline due to a collapsing domestic real estate sector and a severe demographic winter. To truly grasp the immense macroeconomic magnitude of this industrial rebound, we need to look deeply at historical precedents of massive state-driven manufacturing booms. Following the total devastation of World War II, the United States aggressively retooled its wartime factories and unleashed a manufacturing golden age. This post-war industrial boom literally built the modern American middle class and established the nation as the unquestioned global economic superpower. For a century, decades later in the 1980s, we witnessed the astonishing Japanese economic miracle. Through a relentless focus on advanced manufacturing, industrial efficiency, and technological innovation, the Japanese government transformed a war-torn island nation into a global export juggernaut that completely dominated the automotive and consumer electronics markets. Today, the Chinese government is executing a highly orchestrated and heavily funded pivot away from debt-fueled residential real estate development. They are aggressively channeling massive state resources and capital into high-tech manufacturing, green energy infrastructure, and advanced equipment exports. They are actively attempting to manufacture their way out of a domestic economic slump by flooding the global market with high-quality, technologically advanced goods. The 24.7% surge in industrial profits is a glaring, undeniable signal that this state-directed industrial policy is actually working as intended. This massive sudden surge in production has profound long-term implications for global trade, dynamics, and commodity pricing. When the undisputed factory of the world starts firing on all cylinders again, it acts as a powerful accelerating catalyst for the entire global supply chain. This robust demand from Chinese factories is already stabilizing and driving up global commodity markets. The prices of raw physical materials like copper, aluminum, and industrial steel are being driven significantly higher as Chinese manufacturers gobble up natural resources to feed their rapidly expanding assembly lines. The smart money completely understands that this is a generational macroeconomic shift. Elite institutional investors are not chasing the volatile daily headlines regarding real estate defaults. They are methodically and quietly positioning their massive portfolios to capture the immense upside of this unexpected industrial renaissance. They are aggressively accumulating massive ownership, stakes in materials and industrial sectors, fully anticipating that a sustained Chinese export boom will dramatically lift the corporate revenues of global logistics companies, heavy machinery manufacturers, and international shipping conglomerates. This behavior perfectly illustrates the deep psychology of contrarian investing. The average retail investor reads a terrifying headline about a Chinese real estate developer defaulting on debt and immediately liquidates their entire emerging market portfolio in absolute blind panic. But the institutional titan looks at that exact same news headline and realizes that the government is intentionally deflating the real estate bubble to forcefully redirect capital into high-end manufacturing and robotics. By the time the retail herd finally realizes that the industrial rebound is a massive, sustainable trend, the smart money has already captured the vast majority of the financial upside and is actively preparing to sell their expensive positions to the desperate latecomers. Having the psychological fortitude to buy into a powerful, underlying economic trend while the rest of the world is distracted by immediate fears is the ultimate secret to building enduring generational wealth in a volatile world. However, navigating this highly complex macroeconomic environment has just become exponentially more dangerous. For the average person, thanks to the introduction of a terrifying new technological wildcard, or the very first time in human financial history, highly advanced artificial intelligence trading. Agents are being deployed directly into the hands of untrained retail investors on popular mobile platforms like Robinhood. We are currently witnessing the ultimate, dangerous casinoization of the global stock market. Anyone with a basic smartphone can now unleash an autonomous algorithmic bot to trade their entire life. Savings at the absolute speed of light. These artificial intelligence agents are heavily marketed as the ultimate financial equalizer. They promise everyday working people the ability to generate effortless passive wealth without needing any deep understanding of corporate fundamentals, macroeconomic cycles, or market mechanics. But this is an incredibly dangerous financial illusion that aggressively preys on the timeless human desires for easy money and instant gratification. To truly understand the catastrophic systemic risks involved in this technological shift, we must examine the dark history of retail market manias. In the roaring 1920s, the rapid proliferation of unregulated bucket shops allowed ordinary citizens to gamble wildly on stock price movements, using massive amounts of dangerous borrowed money. This widespread illusion of endless easy wealth completely decoupled stock market prices from actual underlying economic reality. This speculative mania culminated directly in the devastating stock market crash of 1929 and the subsequent Great Depression that destroyed the global economy for a decade. Legendary speculators like Jesse Livermore made millions during these panics. By understanding that, when the herd panics, market liquidity completely and instantly evaporates. Fast forward to the late 1990s, and we saw the exact same psychological trap play out perfectly during the notorious dot-com bubble. The rapid advent of online discount brokerages convinced millions of ordinary people that they were suddenly financial geniuses. People quit their stable long-term jobs to sit in their living rooms and aggressively trade fundamentally worthless internet startup stocks. The mass delusion lasted until the speculative bubble inevitably burst, and their entire net worth was vaporized in a matter of days. We saw vivid echoes of this exact same destructive herd behavior during the recent meme stock frenzy of 2021. A loosely coordinated army of retail traders on social media platforms initiated a massive emotional short squeeze on a failing retail company. The resulting financial carnage wiped out multi-billion-dollar hedge funds and forced central clearinghouses to literally halt trading to prevent a complete systemic market collapse. Now take that exact same speculative retail frenzy and inject it with the limitless speed and power of artificial intelligence. When millions of inexperienced retail traders arm themselves with automated trading bots that all react to the exact same news sentiment, algorithms and technical triggers simultaneously, they create a highly unstable and dangerous algorithmic feedback loop. This robotic herd behavior completely divorces asset prices from their underlying intrinsic business value. The severe risks of this new technological arms race are already becoming glaringly obvious. To market regulators, we recently witnessed a major public scandal where a prominent technology employee was formally charged with blatant insider trading on the decentralized prediction market platform Polymarket. This shocking criminal event serves as a stark, undeniable reminder that despite all the incredible modern advancements in artificial intelligence and decentralized finance, the financial markets are still ultimately driven by human greed, human fear, and the relentless illegal pursuit of asymmetric information. When massive institutional trading, algorithms, and millions of highly reactive retail bots inevitably collide in the open market, the resulting friction can trigger unprecedented catastrophic flash crashes. We saw a terrifying glimpse of this reality during the 2010 flash crash. Automated high-frequency trading algorithms triggered a massive, instantaneous market collapse that wiped out nearly $1 trillion in market value in a matter of minutes before human intervention could even hit the emergency stop button. Artificial intelligence trading agents create a very dangerous, false illusion of infinite market liquidity. Retail investors believe they can enter and exit trades, instantly completely failing to understand that, in a true market panic, the artificial intelligence algorithms will all simultaneously attempt to sell at the exact same millisecond, finding absolutely zero human buyers on the other side of the order book. When you hand military-grade, algorithmic financial weapons to millions of untrained emotional retail traders. You are not democratizing finance at all. You are simply setting the perfect stage for a massive, algorithmically amplified wealth transfer from the impatient retail herd directly to the highly disciplined titans of institutional capital. So how do the true titans of capital actually protect their massive wealth and continue to grow their fortunes in an environment characterized by extreme geopolitical risk and unprecedented algorithmic volatility? They absolutely do not succumb to market panic. And they certainly do not treat the global stock market like a digital casino. Instead, they rely on a highly disciplined, completely mechanical approach to global asset allocation that is specifically designed to weather any economic storm imaginable. The current institutional playbook dictates a rigorous, uncompromising portfolio structure, consisting of 55% equities, 35% safe haven assets, and 10% highly liquid cash. This is not a random arbitrary assortment of investments. It is a highly strategic mathematical framework, directly descended from the legendary Yale endowment model, pioneered by David Swensen. It is designed to perfectly balance the aggressive, mathematical pursuit of growth, with an ironclad defense against sudden systemic shocks. Within the 55% equity allocation, the smart money is heavily and tactically targeting the specific sectors that directly benefit from the massive Chinese industrial rebound. They are actively allocating significant capital into global industrial exchange traded funds like the Industrial Select Sector SPDR Fund. They know with absolute certainty that companies involved in commercial aerospace heavy machinery, manufacturing, and global logistics will see massive, long-term revenue growth as international supply chains accelerate their operations. They are also aggressively accumulating strategic positions in the materials sector. Through funds like the Materials Select Sector SPDR Fund, they deeply understand that the raw physical building blocks of the modern global economy, such as copper, steel, lithium, and aluminum, will remain in extremely high, sustained demand as the world continues to aggressively digitize and industrialize. But they are absolutely not abandoning the high-growth technology sector. In fact, they recognize clearly that the true long-term winners of the artificial intelligence revolution will not be the speculative day traders, but rather the massive monopoly companies that provide the foundational physical infrastructure for this entirely new digital age. Therefore, they maintain massive foundational core positions in high-quality technology and semiconductor exchange-traded funds. They view the global semiconductor industry as the absolute physical bedrock of the modern economy. During the famous California gold rush of 1849, the vast majority of desperate prospectors who traveled west looking for gold ended up entirely broke and destitute. The people who actually built massive, enduring generational wealth were the smart, pragmatic businessmen who sold the iron picks, the wooden shovels, and the durable denim jeans to the desperate miners. Today, the advanced semiconductor companies are the exact ones, selling the digital picks and shovels for the massive artificial intelligence gold rush, and their long-term growth trajectory remains incredibly robust, regardless of any short-term market volatility. To aggressively protect this massive growth portfolio from the severe inflationary risks posed by the ongoing crisis in the Strait of Hormuz, elite institutions are maintaining highly strategic defensive positions in the energy and aerospace defense sectors. They understand mathematically that as long as global military conflict persists, the companies that physically extract fossil fuels and manufacture advanced military hardware will generate massive, consistent cash flows. Furthermore, these elite institutional investors are looking far beyond the domestic borders of the United States to build a truly global shield for their accumulated wealth. While American large-cap growth stocks remain a vital, foundational component of any portfolio, the smart money recognizes that international geographic diversification is absolutely critical. In an increasingly fragmented world, they are strategically and heavily allocating capital toward emerging markets, exchange-traded funds that have direct heavy exposure to the booming Asian, manufacturing, and consumption sectors. This international diversification perfectly positions them to capture the massive financial upside of the recovering global trade cycle, while simultaneously reducing their exposure to any single domestic political crisis. Having the correct macro asset allocation is merely the structural foundation of long-term wealth creation, the true ultimate secret to surviving and actually thriving in this chaotic new algorithmic era lies in the uncompromising execution of mechanical, survival strategies that completely eliminate human emotion from the investment process. In an era where artificial intelligence bots can trigger massive, devastating market swings in a matter of milliseconds, human intuition is simply no longer fast enough to react. You must implement rigid mathematical systems that protect you from your own psychological biases and fears, the single most powerful mathematical tool for achieving. This is the rigorous, relentless application of dollar-cost averaging. This incredibly simple yet profoundly effective financial strategy involves investing a fixed dollar amount into your chosen portfolio at regular predetermined intervals completely, regardless of the terrifying daily news cycle or the current market price of the assets, by consistently purchasing shares through both booming, euphoric bull markets and terrifying, depressing bear markets. You automatically mathematically buy more shares when prices are cheap and fewer shares when prices are highly expensive. Over a long investment time horizon, this simple mathematical reality drastically lowers your average cost basis and virtually guarantees long-term wealth accumulation. It completely neutralizes the chaotic noise generated by high-frequency, algorithmic trading and international geopolitical panics. Think of dollar-cost averaging as the steady, relentless, unstoppable march of a highly disciplined professional army, slowly and methodically conquering territory, while the disorganized amateur masses exhaust themselves in chaotic, highly emotional stampedes. However, a true defensive institutional mindset also requires highly active risk management protocols to strictly protect against the rapid, algorithmically driven downside moves that are becoming increasingly common. Sophisticated investors implement strict mathematical, trailing stop losses on their most highly volatile portfolio positions. This highly effective tool completely automates the vital process of capital preservation. It instantly liquidates a financial position if the asset price drops by a predetermined percentage, permanently locking in hard-earned profits and preventing a temporary market dislocation from turning into a permanent catastrophic loss of family wealth. For those investors with deeper advanced market knowledge, employing sophisticated options, strategies such as writing covered calls on core equity holdings can generate a highly consistent, robust stream of secondary portfolio income. It is the financial equivalent of renting out a valuable property you already own to collect monthly rent regardless of the property value. Simultaneously, purchasing protective puts acts as a powerful, impenetrable insurance policy against sudden catastrophic black swan events, guaranteeing you can sell your assets at a fair price, even during a total market collapse. Furthermore, holding a 10% allocation in highly liquid cash is not holding dead money. In a highly volatile, algorithmically driven market, cash is the ultimate offensive weapon. It is the tactical dry powder that allows you to act with absolute ruthlessness when the artificial intelligence bots trigger a mindless flash crash. And fundamentally incredible, global companies suddenly go on sale for absolute pennies on the dollar. Having a massive cash reserve completely eliminates the psychological terror of a deep market downturn and replaces it with calm, predatory anticipation. We are currently living through an absolutely extraordinary moment in human financial history. We are witnessing a massive, unprecedented collision between rapid technological advancement, shifting global trade alliances, and intense geopolitical military friction. But while the specific digital tools of speculation and the terrifying speed of information transmission have evolved dramatically, the fundamental underlying nature of the financial markets remains completely unchanged. Throughout every major financial crisis over the last century, from the dark depths of the Great Depression to the euphoric peak of the dot-com mania, the global market has always been driven by the eternal human psychological struggles between fear and greed, panic and patience. The rapid introduction of artificial intelligence, trading agents will undoubtedly amplify the short-term market volatility and create truly terrifying market swings, but it will never ever replace the absolute necessity for deep fundamental macroeconomic analysis in this unprecedented new era, where human intuition is violently forced to compete with algorithmic speed. True, lasting financial insight does not come from trying to outtrade a machine that can mathematically process 1 billion data points in a single second. True insight comes from stepping back, completely understanding the massive, underlying global currents of macroeconomic change, adapting to completely new realities with highly informed resilience, and focusing your capital relentlessly on enduring fundamental intrinsic value over the fleeting, chaotic noise of the daily news cycle. We couldn't fit all the deep dive details and practical strategies into this video,